Looks like we have a real estate question.
All right.
Someone wants to know what are the tax benefits of owning a home versus than renting one?
Yeah. So not as much as it used to be honest.
Yeah, that's true.
In the old days, when the standard deduction was lower, then it was much more beneficial because on your itemized deductions, again, same thing with the standard deduction versus itemized issue. For your personal residence, you get mortgage interest, at least for mortgage amounts that are less than $750,000, and property taxes. So those two become deductions. They both have limitations on them. And in order to exceed the standard deduction is much less common than it used to be when the standard deduction was lower. So under the old system, we had exemptions based on the number of people in your tax family. And then we had a standard deduction. And in 2017, they got rid of exemptions and they doubled the standard deduction. And the standard deduction has grown every year since because of inflation adjustments. So relatively few people these days can actually itemize their deductions. So the benefit of buying a house for tax purposes for a personal residence is much more muted than it used to be. Now, there are other advantages. Obviously, you have a thing that you own. Your rent is not going to go up on you, assuming you have a fixed mortgage, or your cost of living is going to remain relatively the same. So there's all these different other advantages, but for tax purposes, not much. However, if you live out of that place and you turn it into a rental, then there's a whole lot of tax advantages. So rentals are largely advantaged in the tax code because of things like depreciation, where you can write off a chunk of the cost of the structure due to wear and tear over time. And there are different games to play with that, with cost segregation and other things that are. So personal residence, not so much. Investment property, lots of advantages.
Okay, so it looks like we have another real estate question. So someone is thinking about getting into investments and they're trying to figure out if they should invest in a property for a long-term renter or an Airbnb. What do you suggest them to do?
I don't suggest either one because I don't make recommendations, but there are different pros and cons.
Okay.
Advantage to the short-term rental is that if the average stay is less than 7 days, a it is not a rental activity, which means it's not passive, which means you're not subject to the limitation on passive activities. Let's say you're married, you and your spouse, between the two of you, you bring in $150,000. And then you have this long-term rental real estate where rent is $1,500 a month, 18 grand a year. You have expenses, you have depreciation. And by the time it's all said and done on a tax basis, you have a 10,000 a year loss. So 150 grand day jobs, $10,000 loss on, you would think that, okay, I made 150 here, I lost 10 here, my net should be 140. And you would be right because there's this thing called the passive activity loss limitation. So if you make over $150,000 between all sources, then the amount of loss you can take from passive activities is zero. If you make less than 100,000 from all activity, from all sources, then the passive activity loss you can take is limited to 25,000. And then as you go from 100 to 150, it scales down until you hit zero at 150,000. So that's one of the challenges with long-term rental. Now, there are ways to get around them. There's material participation, there's real estate professional status and other things. But that's the kind of the base scenario. If you're doing short-term rentals, then the passive activity loss rules do not apply because you're effectively in a trader business you're in the hospitality business. So it's not passive and those rules don't apply. So if you have a short-term rental with average stay less than 7 days, same numbers, I make 150K between me and my spouse's day jobs. I lose 10 grand net on a tax basis. And so now my net really is 140 and my taxes are lower and we have larger refunds or owe less or whatever the case might be. So that's the major advantage to short-term rentals because of that active nature of it. It allows for deductions when you couldn't have deductions otherwise. It also allows for it allows for cost segregation strategies where you can accelerate the depreciation by breaking up the property into its different components and then depreciating them all quicker in early years and have less depreciation in later years. And time value of money, a depreciation or a deduction now is worth more than a deduction 30 years from now. So that's the advantage of short-term rentals. The disadvantage of short-term rentals is that it's a lot more work when the IRS has their rules that it's not passive. They are actually correct because it is not passive. So whether you're doing it yourself or whether you're paying a manager, the managers will charge a lot more. So long-term rental, a manager will charge you 8, 10, 12%. Short-term rental, a manager will charge you 30%, 40%, and they do that because it is a lot more work. You have to factor that in. Now, in the right markets, I have seen short-term rentals be wildly successful. In the wrong markets, I have seen them be wild failures. Your rewards are higher, but your risks are higher. So there's that. Now, the advantage of long-term rentals is that fundamentally, worst case scenario, you have tax-free income. So whatever cash flow you get out of the property, because the depreciation offsetting, even if you're not able to offset other income, you're still not going to be paying taxes on that cash flow you get from that property. In most cases, asterisk with that statement. So there's that. It's a much simpler business to operate. It's a much simpler thing to do. And fundamentally, what you're doing is you're building equity over time. And hopefully you get some cash flow as well. That'd be great. And you want to get at least some positive cash flow to build your reserves for that property when you have to replace the roof or water heater or whatever. But if we're talking about one property or one single family house is not going to retire you. So if you have 10 of them or 20 of them, then then you could talk about quitting your day job. But if you're making $300 a month net after all expenses are paid, then it takes a lot of those. But what you are doing is you're building equity because as you have a mortgage, you're paying down the amortization on the loan. The property is probably appreciating just due to the nature of inflation and the fact that we have a growing population, assuming you buy in a somewhat desirable area. So that's the long-term wealth play. Short-term rentals have some tax advantages because of their short-term nature at the expense of a lot more work. Long-term rentals have fewer tax advantages, but are much easier to operate and are building that long-term. So the short-term stuff, if you're in a vacation area, a lot of those will buy and sell as a business, meaning that it's dependent on the net operating income of the property. So like I was looking at a guy who was building cabins in Gatlinburg, Tennessee, Smoky Mountains. There's a lot of very popular thing to do over there. Just know that it's a different beast when it comes to buying and selling as far as what they're going to cost, because it has this business element to it. Now, and then there's some crossover there. If you're doing a short-term rental in a normal or long-term kind of area, that you might get some single family house tax appreciation, even though you're operating it like a business. Real estate's very local in terms of how everything prices. You got to be aware of what you're doing, basically. But that's the two basic elements to short-term versus long-term rentals. They both work. They both have different advantages and different disadvantages. And again, we don't make investment recommendations.
Understood. So we have a question about RMBs. Someone wants to know, what should people know about required minimum distributions, RMBs, and taxes?